You're listening to Kitchen Table Finance. Join Dave Shotwell and Nick Nauta as they cut through the complexity of financial planning and serve bites of investment advice that are both personal and practical.
Hey, Dave, how you doing today?
Not bad, Nick. How are you?
Good. Sun is shining, so it must be time to do a podcast, right?
I saw the sun for 10 or 15 minutes earlier, so we'll call it good.
That's about all you get up there this time of year anyways, right?
That's right.
So, interesting topic today, Dave. So let's just dive right in. And that is, when it comes to planning and retirement planning, what are your key numbers? And also, how often should you review them? It feels like, and especially in today's world, there's a lot of different numbers out there. There's a lot of different things that you can stress about. And so I think it's twofold for today, right? Like, what are those things that are actually important?
Right.
Might surprise you, probably not what you think. And number two, how often should you look at them? Do you need to be, reviewing these things daily, or, what's best practices for not driving yourself crazy, right?
Right. And that's kind of where this topic came from, right? Is we've spent a few minutes on the air over the last couple of months, reminding people that they shouldn't be obsessing over their portfolio and checking it constantly and driving themselves crazy. And we've talked about the statistics about how people tend to actually do worse the more often they check on things, because they make irrational or emotional decisions, I should say, not necessarily irrational. But so it just kind of begs the question, right? What should we look at, and how often should we be looking?
Yeah, absolutely. And, we've kind of talked about it quite a bit, but we don't, paying attention to the market isn't really going to do anything for you.
Yeah.
Right.
So, and I kind of feel like we're at cross purposes as advisors sometimes. I never want a client to feel like they can't know how they're doing, right? Or they shouldn't, I'm not going to withhold information from them. But there's a lot of times when it's just like, really, we should put you back on annual statements and just, just don't look at this for right now, because I don't want you to stress about it, because there's nothing you can do about it that time won't take care of.
Right.
And, it's more likely to cause you to make mistakes.
Yeah. Maybe we need to develop some sort of app that, like, after so many logins says, you don't need to see this right now.
You're done.
Go take a deep breath.
Done. I see. And professional ethics come into play there a little bit. And I'm not sure the SEC would be real happy with that response, but the behavioral finance folks would be like, yeah, that's spot on. Right. So, all right. So what is a healthy approach? What should people be looking at? I think we like to talk, at least on a high level, about the behaviors that drive success, right?
Absolutely.
The things you can control.
Oh, yeah. I mean, that's such a big thing, right? Like, no matter how many times you look at the market, there's nothing you can control or change. And so by focusing on the things and the behaviors that you should be doing, you can actually drive meaningful change, especially over a longer period of time, right?
Right. And the number one driver of building wealth is your savings rate.
Right. Yep. Should be, the number one number that everybody should probably know is, as you're gearing up to retire, is what, how much are you saving? What's that percentage of income that is going into long-term savings?
Right. Because the market will take care of itself. And if you are just consistently doing the right thing and putting money away, you'll get there.
Yeah.
You'll get there.
And that, again, is a behavior thing. And a couple things on savings rate, right? Like, ultimately it is important. We have kind of a general range that we usually want people to be in, but it's general because it's different for different goals, right? Like, if you came in and you wanted to retire at 50, you're going to have a higher savings rate than somebody that wants to retire at 67. And both of those are okay. It's not a measuring stick to say, well, my neighbor's saving 30% a year, so I want to do that, even though, maybe you don't ever want to retire. You want to retire later rather than earlier, right?
Yeah. I remember going around and around early on, like middle of my career, when I had just made the switch over to like project, more planning focused than investment focused, and a younger engineer type wanting not just to, like, he wanted to be benchmarked against his peers. And, which I understand, but I spent a lot of time trying to explain to him how, his peers weren't necessarily what he thought they were in terms of what he should be measuring himself against, because his goals were, I don't remember what they specifically were, but it was like, we need to like take a subset of your peers that have the same goals as you, and good luck figuring out who that is,
Right.
But anyway, that's a different conversation, but everything's relative.
Absolutely. And, even your closest peers, you may not, want to measure up against, because they might have completely different goals, right? So it's more about you than it is about somebody else. It's a dangerous game that you can start playing.
Yeah. Yeah. And go ahead.
So I think that, obviously savings rate is the percentage of income that you're saving for long-term goals. Now I say long-term goals because not, maybe it's, maybe retirement isn't your number one goal, right? Maybe you want to provide college education for your kids before retirement. So it's kind of a combination of both of those things. It doesn't necessarily just mean retirement. But I think in kind of the best way to start focusing on this is figuring out where you're at. And also, if you're not where you're at, how do you improve? And that starts with a budget.
A budget. We can't get away from that, can we? So you want to look at like if we get granular on savings rate, start with are you on a monthly basis? Is your budget balanced? Start with that, because if it's not, it doesn't matter what the market did tomorrow, or it does tomorrow, what it did tomorrow. It doesn't matter what the market does tomorrow. It doesn't matter what the market does 6 months from now or 6 years from now. If your budget's not balanced and you're accumulating debt instead of savings, what difference does it make?
Right. Especially if, you're paying 25% on credit card debt. That's not a winning, not a winning equation compared to what you could do with putting money in long-term investments and retirement plan. Yeah. So, and the other thing that I would think of, obviously of getting that budget and figuring out what your long-term savings rate goal should be, but also, not thinking about, okay, well, I need to be at 20 and I'm at 10. So, that's a big hill to climb. It's not like you have to be at 20 tomorrow, right? Like, what are some of the steps that you can do? How do you get a little bit closer every year until you get to that point? I think is huge, right? What's the best way to eat an elephant? One bite at a time, right?
I hate the gory pictures that brings to mind, but I think of like one of our favorite financial planning writers is Carl Richards, and he says, just find that one small thing you can do right now, right, and do that, and then figure out what the next thing is. And if that's increasing, if all you can do is increase your savings rate by 1% right now into your 401k or whatever, go do that thing, and then figure out where the next 1% is going to come from.
Yeah, absolutely. And I love telling people too, especially when it comes to savings rate, tied into your, annual cost of living adjustment, right? So if you get a 5% raise, you put one in, you're still making more money. It still shows up as more in your paycheck, but you never knew that 1% is now in your long-term savings goal.
Right.
So a couple of other elements that are important, or a couple of other rates, numbers that are important. One of those is debt rate.
Yes.
So your debt rate, much like your savings rate, is just tallying up how much your, monthly debt repayments are and dividing that by your total income, right? So that should be your debt rate. And to give you some sort of idea of where that should be, it's different for everybody. It's different for all kind of stages of where you're at, right? But just kind of a general, overall average, looking at people. If you're 40% or over, that's definitely on the high side. One of the first things that we'd probably look at working on is how do we get that number lower if you are sitting down in front of us with a 40% or more debt rate. Most people are on average are around the 20 to 30% is a, relatively healthy debt rate, especially depending on when you're, having those conversations, right? and then low would be the 10 to 15% range.
And that's an important thing that comes into play if you're looking to buy a house.
Right. Oh yeah.
It's one of the metrics the bank's going to want to use to determine how big a mortgage they'll let you have. So,
which is interesting, and I always tell people this. The bank will try to do anything to get you into a big house. So, like, they're not afraid to go over that 40%.
No,
but you probably should be.
Right. If they are, you need to think about things.
Yeah. And I think too, obviously the closer you get to retirement, the lower your debt rate should potentially be, right? Like, you probably don't want to hit that retirement mark and still have a 40% debt rate.
So when you're looking at your metrics, you want to increase your savings rate, you want to decrease your debt rate. And talk to me about total term. I like this one too.
Yeah, so total term is basically, if you take your net worth and divide it by your spending, right? So how much you spend on an annual basis, that should give you your total term, right? And it's kind of this idea of, it's the number that we use to tell people this is your make work optional bucket, right? Like, if you get this number high enough, right? So if you have a total term of, say, 25, that essentially means you could live off your net worth for the next 25 years without having, without factoring in anything like interest rate interest rate on your portfolio, market gains, things like that. Just thinking of it in terms of net worth divided by your spending rate. So obviously the higher that number is, the more, work is optional for you. And the goal is to increase that over time, right? So when you're in the 25 to 35 range, it's pretty normal to have a total term of, 5 or less, right? Like, you're just building that net worth. You've got a lot of stuff going on. The closer you get to retirement and what you want your retirement age to be, that number should be higher to, so you have a net worth that's capable of producing the income that you need so that you don't have to have work. And the interesting thing about it too is, those two things that we just talked about, your savings rate and your debt rate, if you can increase your savings rate and decrease your debt rate, your total term is by default going to start going up. All right. Those are the behaviors that you work on. And the outcome is what happens to your total term.
Yeah, that's a good way to look at it. That's where you'll see the success by that total term rising.
Yeah.
Nice.
So, and I like to say, this is your, make work optional, because again, not everybody wants to retire, but most people want to be in a position to, that they can if they want to, but they can choose to continue to. So it's just another unique way of looking at that, because everybody's experiences and everybody's goals are a little bit different. The other one that is also important, and this kind of relates to, we already talked about budgets, but now we get to talk about emergency funds, right? And that is your liquid term. So the same concept, except for instead of using your net worth, we're using your liquid reserves, cash or things that are available to you. And we're dividing that by your savings rate. So for example, if you have a liquid term score of 1, that means you have enough in liquid available investments, savings, cash that you could cover 1 year worth of expenses, right? And so that number, obviously, like we've talked about several times, as far as contingency emergency funds go, right? We want to be at least a minimum of 3 to 6 months, right? So 0.3 to 0.5 on liquid term, but it will also depend on where you're at in life as well, right? Or if you have major purchases or things that are coming up. So, you may have a higher liquid term if you're planning on buying a house next year,
right?
And want a big down payment because, you don't want to invest that, or you don't want that money tied up.
Yeah, you should actually mentally segregate that down payment money from your liquid assets when you do the math for this, so you're not creating a false sense of liquid term security.
Yeah.
I like that though.
But and also, where you're at career wise, right? When you're younger, it's going to be probably lower because you got other things going on. But as you, progress, you're probably going to have a higher liquid term score. Also your family size, right? Like, more people involved, more people dependent on your income, probably the higher you want that score. And then also, income variability, right? So I've got people who carry a pretty high liquid term score, but they also, on a year over year basis, they're not sure exactly how much they're going to make, right? And if that
Right.
varies widely from year to year, you need more money in liquidity so that you have the ability to supplement your income. So if you're used to making 250 and you have a year where you only make 150, you're going to want a bigger liquid term score than someone who is got a guaranteed 175 every year with very low potential for that to go away or move up or down.
Yeah.
So just some things to think about, right? Like everybody's scorecard is a little bit different and you have to evaluate it in different ways. But just thinking about those three things, I think it's important to know what those numbers are and assess where you want them to be, and then make the decisions and make the hard choices of how to improve those or keep them where they're at, if that's where you're at.
So we've spent 15 minutes on this so far, and we haven't talked about once logging into your 401k or your custodian for your investment account, right?
Yeah.
So our take on that is really, I guess the way I put it to people is if you designed it right, you change your portfolio when your circumstances change. So, assuming someone's done the right things to set their portfolio up in the first place. We can come back to that. But you really shouldn't need to do much.
Right.
Other than monitor your contributions or your distributions, depending on your phase of life, and update the allocations when your circumstances change.
Yep.
So in terms of monitoring your balance and seeing how things are going, this is tough. I tend to think that for most people, if they were to just look once a year and make sure nothing weird has happened, they're probably in pretty good shape.
Yeah.
If they've done the homework, if they've done the right things in the first place, worked with someone or put together a coherent asset allocation plan to start with.
Mm-hmm.
The big thing is it's not about the markets, right? Because we know, like if you've put together like the smartest portfolio in the world that is truly diversified and is set up correctly, there's always going to be something in there that looks really dumb.
Right.
Yeah. I mean, and there's going to be a few things that look really good, but if you've done the work to make sure that you're allocated properly, it's not that those asset classes that underperformed and those funds that you chose to represent those asset classes are bad. It's that it wasn't their time, and their time will come. So you don't want to put yourself in a position of moving things in and out based on short-term performance anyway.
Right.
We do believe in rebalancing, but for most people that we talk to that are just investing on their own, most of their portfolio is in their 401k, right? Or their retirement account. So if they're contributing to it monthly, their allocation's probably not going to get that out of whack anyway.
Right.
So, I mean, if you're investing in, say, just a stock fund and a bond fund, and you're putting $500 into each every month, and one's going up and one's going down for a certain period of time, those contributions are going to kind of rebalance things automatically in a way.
Right.
Unless things get really screwy. So, we go in with our fancy schmancy portfolio management software, and we rebalance every quarter, and we rebalance when people make contributions or distributions. But by and large, for most people, that's not going to even really be necessary.
Yeah. It's one of those things where I'll tell you how I do it and how I view my portfolio. And it is usually, maybe it's less than, maybe 2 times a year. And sometimes I'm usually only in there because I'm like looking something up for somebody else. Like, how do I, how do I go into this app and do something? So I go into my own personal stuff. I'm not necessarily looking at my own portfolio. Yeah. I'm just trying to figure out how to use a part of an
different
app.
Different IRAs at different custodians. Yeah.
But I use it more for like from a psychological perspective. Like if I'm having a bad day in terms of like looking in terms of money and how I'm feeling about my own personal situation. Mm-hmm. There are times when I will go in there, especially if the market's up, and just look at, okay, look, we had a good, we made X amount of dollars in our portfolio. That makes me feel pretty good. All of a sudden I'm feeling better about our overall financial situation. Right. Mm-hmm. Or, so obviously avoid doing that in down markets, because you don't want to make, check what the stock market's done in the last 6 months before you actually look at your portfolio. But it's funny. And this goes back to something that Morgan Housel said. Oftentimes we stress over like making a purchasing decision or something along those lines. Like, and that really has no impact on, our long-term goals or things like that. And so I like to be able to go in there and look at things like my total term score, what the overall portfolio is, because it helps center and remind me that, yes, we can do this thing. It's not that big a deal if we spent more than we thought we were, because look at, we're still doing all the right things. And sometimes by checking my portfolio, it makes me feel better about the little stuff that I sweat too often.
Right. Well, and I think a lot of people lose sight of the fact that, particularly when you're starting out, we may be a little too old for this to be sound advice, but take your average 25 or 30-year-old. They may obsess over the funds and the stock market movement, but if you're just starting out in that 401k plan and your denominator is 0, who cares what the return is? Right. If you're putting $400 in every month, your contribution is going to add up way faster than anything the market can give you or the market can take away. Yeah. So from that point of view, when you're hearing bad stuff going on in the market, open up your portfolio and remind yourself that I'm doing the behaviors of putting that money in there every month. Yep. And that's going to make the bigger difference. So,
I mean, if you're young like that, you should be praying that the market goes down, that you get
should.
A big correction.
I haven't convinced anyone to actually do that, but you
should be celebrating the market going down.
Yeah,
that's a really good thing for you in the long term.
We've talked about that. I've yet to find anybody who any 25 or 30-year-old who likes to see minus 10% and think about the fact that it's just like going to TJ Maxx to buy a coat instead of Nordstrom's.
We're gonna have to put that in our app too, right? Like in Robinhood, when you do a trade, there's like confetti that comes down. We'll do confetti when the market's down like a certain percentage. Yeah. Congratulations, your next contribution is going to buy this many more shares.
So the big thing is, again, though, with all of that advice, is focusing on the behaviors. Did I allocate my portfolio properly? Yes. Then it doesn't matter what the balance is. If you're not adding regularly or you want some structure around rebalancing, if you did it once or twice a year, that's probably good. And you just, each fund that you have, you assign a percentage. If you've got a stock fund and a bond fund and they're both, maybe you're 75% in stock and 25% in bonds, rebalance back to those targets twice a year if you need to. And you don't need to do it if they're not perfect. Do it when they're 3-4% out of whack, it's not magic, but the discipline is what's important.
So, I completely agree. And, I think one thing, Dave, that I'll pose the question to you, and I think people think about this a lot, like when you're thinking and you're going into retirement, like at what point do you want to look at your portfolio and start adjusting it because those circumstances are changing, because you're getting closer to retirement?
Mm-hmm. Well, there's other factors that feed into that, and that liquid term idea, so it's hard to say, blanket advice wise, but what we want to see is that, folks are going to have a couple years worth of income, whether that's in their retirement accounts or outside of retirement accounts that is in safer assets as they move into retirement. And, we kind of set that glide path up, right? Where, at some point in middle age, you're going from being almost 100% stock to being, we usually end up with most of our retirees somewhere around 60%.
Yeah.
Depending on their risk tolerance and what their plan will allow.
Yeah.
So again, there's no one size fits all, but but that falls into that grouping of, okay, life is changing, so once a year, if you're doing this yourself, maybe you've set a plan that once a year you're going to go in from age 50 to 60 and reduce your stock holdings by a certain percentage. And you just do it automatically, and you don't do it based on what the market's doing. You just do it.
Yeah.
So.
Yeah, I mean, you're so right, because everybody's situation is different, right? Like, there's no hard and fast rule, and not everybody's going to be using money from their portfolio the day they retire. Right. Some people will have other sources of income, some people won't. So there's a big difference there in how you allocate risk. But I think also, I love your point about, like, just when you get, however many years away where it makes sense for your situation, you're going in every year and you're making that adjustment. You're thinking about it. Doesn't necessarily mean that you're going to, but you start thinking about that stuff, start having those conversations. And this is another reason why it's hard to do it on your own, because if you're having those conversations with yourself, right?
Right.
It's a difficult, because there's no hard and fast rule, there's a lot of factors you need to look at. It's hard to do that kind of stuff on your own.
Yeah.
But, if you have an advisor that you're working with, I usually tell people, 10 years out, it's probably worth starting to have those conversations about what that looks like and what your glide path should be. Not necessarily saying that you're going to do something 10 years out, but at least you're going to have that conversation to decide, yes, we're going to do this, or no, we're not going to, but you need to start having that conversation, right?
One of the insurance companies that held themselves out as retirement planners, so I'll leave them unnamed, but I like their ad campaign. It was maybe 5 or 6 years ago. They called it the retirement red zone. And it was like, I think they literally went 10 years before and 10 years after.
Right.
Those are the times when you need to be paying attention to your asset allocation and how that glide path looks. So, and that's, we don't need to go into that too far right now, but essentially you've got to be the most cautious right around retirement.
Yeah, absolutely. Awesome. Well, this has been fun. Hopefully it has been helpful. Would love to hear from our listeners. If you have a metric or a ratio that you pay attention to, shoot us at info@srbadvisors.com. But as always, Dave, this has been great. Appreciate your time, my friend.
You bet. Good stuff. Thanks, Nick.
This is a Zedia Media production.